Hey you my people, today we are talking about Forex, alright? And today we're just covering Forex for beginners. We're gonna be talking about how to trade Forex and how to get started as a beginner. Alright, what do you need? What kind of information do you need basically to navigate these financial markets? So the first thing is, what is Forex? Alright, and as I've written here, Forex just means foreign exchange. And this is taking advantage of different currency strength or the different currency values of various economies to be able to profit according to your anticipation whether the market is going to buy or it's going to sell. All right, and this is actually a very simple concept, and then I'm going to explain to you to the details, the most intricate particulars about Forex. How literally do you get started and what do you need for you to be able to trade in this particular market? All right, now without further ado, let's dive into it. So Forex, we have said, it's basically the foreign exchange, and it's actually the world's biggest financial market. All right, it's traded around 6.5 trillion dollars every single day. All right, this is the amount of money that circulates in this particular market every day, and this is presumably the best market for you to be able to trade, because it has quite a lot. All right, and you don't just trade market casually. You just need some basic information about the Forex so that you can be able to trade effectively. All right, another thing to note about Forex is that it is open 24 hours 5 days a week. All right, it's open 24/5. All right, so this means during the weekend we're not gonna be trading, but in between Monday and Friday you are welcome to trade in the Forex market every single day. All right, and then the thing that we have to note also is that Forex market has no specific location. This means it's decentralized. You might be asking, where exactly is this market? So this market has no central authority. The Forex market has no central authority that governs it. So it's not governed by any specific body. We can say it's anarchic in nature. The Forex market does not has any structure in terms of governance that governs it, and it does not have a strategic physical location that you can be able to go and find people trading. This means it's decentralized and it's everywhere. All right, so you can be able to trade it in any part of the world that you are, in the village, in the city, anywhere you are, you can be able to participate in this particular market. All right, now let's look at the key participants in the Forex market. All right, who are the people who trade in this particular market? Now, the first people who trade in this particular market are basically, or who participate in this particular market, are literally what we call brokers. We have people we call brokers. These are corporates. Then we have dealers. I'm going to explain who are these people. All right, who are dealers, who are brokers. And then we have another category of guys who trade in this market called banks. These are participants as well in this particular market. And we also have governments. All right, we also have governments. Right, now brokers are basically companies that be able to give you or link you to the real market. Like brokers act as a link in between retail traders and the financial market itself. All right, now dealers are specific individuals like you and me who are interested in trading in this particular market. All right, then banks, of course, are financial institutions that are responsible maybe for exchange rates, saving money and all that. Everybody knows what banks does. Then the governments, of course, participate in this particular market, and I'm going to be explaining how they participate in this particular market. All right, now after that we want to look at definition of terms. All right, there are some terms that are specifically used in this particular financial market, and these are the terms that you must understand even before you start trading. And the first one is what we call PIP. All right, now what is a PIP? PIP basically means percentage in point. And what that means is basically this is the unit of measurement that we use to measure the movement of this particular market. For example, if you find a currency pair like GBP USD, I'm going to be explaining what is a currency pair later, and you find it's quoted at 1.2563. All right, then we say that this particular market has moved 1 pip. If it moves from 1.2563 and now the new current price reading becomes 1.2564, right? So that is a complete 1 pip move for this particular market. If it moves from 1.2563 to 1.2564, we say this market has basically moved 1 pip in either going up or going down. So whether in profit or loss, it depends on your anticipation. If you have anticipated for a buy and then the market moves upwards from 1.2563 to 1.2564, we conclude that this particular market has moved 1 point, all right, or 1 pip in profit. All right, pip is also called a price interest point, all right, to mean the movement of this particular market in the direction of your buyers or the opposite. The second term that you need to be able to understand even as you venture into this particular market is what we call spread. All right, what is spread? What is spread? Now, different brokers give different spreads. All right, different brokers give different spreads. Spreads are basically given by the broker, and the spread is in the difference between the bid and the ask price. Bid and the ask price. Now let's talk about the bid price. All right, let's say you are trading GBP USD, for example. This is your currency of interest, and you find that this GBP USD is quoted at 1 point. All right, let's say 1.2871. All right, 72, for example. All right. Now this what we are having here is called a price quote. All right, a price quote, and a price is quoted either in the bid price and an ask price. All right, so we can have GBP USD. This means USD is quoted at 1.2873. All right, 72, and then we can have the GBP, which is in the other side, quoted, let's say, at 1.2870. All right. Now, the difference between the bid and the ask price, because this is the bid price and this is the ask price. The bid price is the one that you are willing to buy at, and the ask price is the one that you are willing to sell at. All right. So for GBP USD, if you want to buy GBP USD, the implication will be you are willing to buy this particular GBP USD, this particular asset, at 1.270, and you're willing to sell it at 1.2872. Now the difference between this buy price or this particular buy price and this sell price is what we call the spread. The difference in between what you're willing to buy for that particular market and what it is selling at, in between there is what we call the spread. And the spread basically covers the profit of the broker. That is how the brokers make money, literally. So brokers make money from those particular spreads, and also it covers for the cost of purchasing that particular asset, all right, or the cost of transaction in that particular asset. Of course, the broker will make more money from commissions, other things we call swaps. We're going to be explaining what those are later as we continue, right? So this, I've just explained about the spreads, and I've said the spread is the difference of the bid and the ask price. The difference in those particular prices is what we call the spread. Now, the third thing that you're going to be interested to know is what we call the leverage. The leverage is the third thing that you're going to be interested to know what it is. And basically, leverage is borrowed capital. All right, leverage is basically borrowed capital. Leverage is basically borrowed capital. All right, so this one we can say it's borrowed capital. Borrowed capital from your broker. All right, so your broker gives you money that indeed you do not have such money for you to be able to increase your purchasing power in the market price. All right, and leverage is quoted in ratios. For example, you can find a broker giving you a leverage of 1:1,000, for example. All right, it's quoted in ratio 1:1,000. Now, if the broker gives you this kind of a leverage, the direct implication to this statement is $1, every $1 you are transacting it as if you have $1,000. So if you have $100, if you have $100, all right, and you are trading with a broker giving you a leverage of 1:1,000, it means that you are trading as if you have 100 times 1,000, which literally will be like you have 100,000 $100,000 worth of the market purchasing power. So you can be able to purchase instrument, or you can be able to purchase forex stuff like you as if you have 100,000, but in reality you have only $100. But I want to warn you against this particular leverage. The greater the leverage, also the more the risk, right? The more the risk and the more the reward as well. So if you can be able to find a medium leverage, the better for you, because the more you increase the leverage, the more also you are exposing your capital to risk. So that is what we call leverage. Leverage, we have said, it's basically borrowed money by the broker, so that you can be able to increase your purchasing power in the marketplace. All right. Now we're gonna be talking about the currency abbreviations. We're gonna be talking about the currency abbreviations, and different currencies are abbreviated differently. All right. Different currencies are abbreviated differently. Now, the first and the most popular currency that is traded is what we call the USD, which is basically the short form of the US dollar. The USD, also known as the US dollar. We have the AUD, also known as the Australian dollar. We have the NZD, also known as the New Zealand dollar. NZD, the New Zealand dollar. We have the CAD, also known as the Canadian dollar or the CAD, Canadian dollar or the CAD. Then we have the GBP, also known as the Great Britain pound, and then we have the JPY, also known as the Japanese yen, or simply the yen, and then we have the Swiss franc. All right, we have the Swiss franc, also known as the Swiss. So these are basically examples of some of the currencies that we abbreviate to be able to get currency pairs from the market when we are trading in the forex market. Now, we have two kinds of currency pairs. We have major currency pair. A pair is basically a combination of two things: a pair of trousers, a pair of shirts, a pair of socks, a pair of scissors, whatever you're doing, provided it's two things combining together. Pair of slippers. So a pair is literally a combination of two things. Now, if you combine two currencies, you get one currency pair. Right? For example, if you pick USD and JPY, all right, you combine USD, you combine I want a path, you combine USD and JPY, you get something we call USD JPY as a tradable forex pair. All right, so now this is a currency pair which is tradable in the market. If you trade, for example, you take CAD, you take USD and CAD, all right, you get USD CAD at forex tradable currency pair, USD CAD. Now, this is it. We have basically two kinds of pairs. We have the major and the minor pairs. Now, major pairs are those pairs that has USD in them. You can pick any and can be able to combine the AUD. You can be able to take NZD, GBP. You can be able to take JPY. You can be able to take CHF. But provided you combine that particular pair like with USD, it becomes a major currency. For example, GBP USD, that's a major pair. USD CAD, USD CAD, it's a major pair. All right. Any pair that you combine to US dollar becomes a major pair. We also have the other category which we call the minor pairs, and these pairs do not have USD in them. For example, when you take a pair like AUD CHF, all right, AUD CHF, AUD CHF, those are called minor pairs. AUDCHF. All right, AUDCHF. AUD JPY. All right, or whatever pair that you will take and you combine, provided it does not have a USD in it, is basically a minor currency pair. So if major currency pairs, and we have minor currency pairs. Major currency pairs are basically the one that has USD in them, and then minor currency pairs do not have a USD in them. All right. Now, with that in mind, now we come to the aspect of trading. All right, we come to the aspect of trading itself, and how do we trade? Now, trading basically entails buying and selling, literally, even from the normal contemporary business aspect. Now, buying and selling of specific commodities, instrument, or whatever you have that you have to trade. Now, when we talk of trading in the forex market, we buy and sell this particular currency pair. That is what we call forex trading. All right. Literally, we have so many instruments that are engaged in when we talk of trading. We have metals, we have commodities, we have indices, and so many things. We have stocks. So we can be able to trade so many things. Now, the concept of buying and selling is attributed to just anticipating whether the market is going up. A market which is going up, we call it a bullish market. A market which is going down, we call it a bearish market. Now, the market which is going up, we say it's a buying market. For example, when you look at this particular market over here, you can be able to see this market is continuously rising upwards. So we call this one a bullish market. If you look at this particular market here, it's dropping downwards. So we can be able to conclude this is a bearish market. If you look at this particular point, you can see here this particular market was bullish, and then it started a bearish movement. Now, this bullish movement is what we call buying. You can say this market is buying, and then this market from this particular point going downwards, you can say this market is selling. Now, you make money when you anticipate correctly. All right. If, for example, this is where the market was initially at this particular point, please pay attention. If at this particular point, this is where you found this particular market at, then you anticipated that this market is gonna buy from here, all right, and you entered a buy position from here. This is XAU all right. I'm gonna be showing you what is XAU. I know you just covered about the currency pairs. So if you anticipated for a buy from this particular place, and then you bought here, and then the market went up, you will literally be making money as the market goes up. But if you anticipated for a buy here, for a sell here, and you were wrong, the market continued to buy here, you could have incurred what we call losses. So that is basically how easy we make money. So if at this particular point you were convinced that this market is gonna sell, if at this particular point you were convinced that this market is going to be a selling market, and you placed a sell position from here coming downwards, you could have made money as the market dropped to the downside. All right. So this is how we call a market which is selling market, and we make money when we sell and the market goes to the downwards direction, or to the bearish direction. Now, for you to be able to come up with a decision whether the market should buy or sell, you literally do not do what we call guesswork. All right, you don't do guesswork. You don't guess the market is going up or it's going down. There is an approach that you're supposed to use for you to be able to determine the direction of that particular market. All right, and for you to achieve that particular decision, whether the market is going up or down, or for you to be able to come to a conclusion on the direction the market is likely to take, there is something that you have to do which we call analysis. All right, there is something that you have to do that we call analysis. All right, there is something that you have to do that we call analysis. And when you talk of analysis, we have basically two models of analysis. You can do what we call technical analysis. All right, you can do what we call, let me get a path. You can do what we call technical analysis. You can do what we call technical analysis. Technical analysis. Or you can do what we call fundamental analysis. All right, you can do what we call fundamental analysis. All right. Now, what is fundamental analysis and what is technical analysis? Now, fundamental analysis involves looking at the price action or the price action in the previous history to be able to determine how the market is likely to behave in the future. All right. So this is like looking at a few previous market behavior to determine how this particular market is gonna behave. For example, if you look at this particular market from that particular point, you can be able to see every time the market taps this particular trend line, it bounces to the downside. All right, so you can say it bounced from here, market bounced from here. So 90%, or there are chances that probably if that market taps again, that particular point is likely to drop again. And if it comes down here, it is likely to drop again. So the next subsequent traders might come to an agreement that every time this market will be tapping this particular point, it will literally be selling. And so they will be able to take advantage of that particular trading opportunity, which is as a result of the market future or previous behavior, right? When you look at this particular market, also from this particular point, um, you can be able to see that this market is behaving from this particular point, all right? Every time the market taps this particular point, it goes up. Anytime it taps, it goes up. It taps, it goes up. So you can be able to conclude maybe in the coming future, if this market drops all the way down and taps, maybe this particular point is likely to buy from that particular point. So you take advantage of this. It is what we call technical analysis, taking advantage of how the market has been behaving in the previous history to be able to determine what it might do in the upcoming future. That is what we call technical analysis. Now, on the other field or the other side, we have what we call fundamental analysis. And fundamental analysis is different from technical analysis in the sense that fundamental analysis involves looking at the economic indicators and things like the gross domestic product, things like inflation, things like employment or unemployment, to be able to determine which of the currency, because literally we are talking about currencies of economies which are practically operational. So you can be able to look at the economic indicators of that particular currencies to be able to determine whether that currency is going to gain or lose, right? Because if you pick, for example, you pick a buy, let's say you are trading euro and the USD, as we have just said, when we are talking about currency pairs. So if you are taking euro, you mean that if you are taking a buy on euro USD, you mean that the euro should gain value and the dollar should drop in value. So this means you are anticipating that economically euro should be stronger than the dollar. So comparison of those two economies, you can be able to achieve that by looking at the economic indicators like gross domestic product, inflation, unemployment, interest rates and monetary value, political events, government policies, and central bank statement. So we're going to be talking more on how to do a fundamental analysis, and also how to create an harmony in between technical analysis and fundamental analysis for you to be able to get the best trading setups. So we're gonna do this. Remember to subscribe into this our new YouTube channel, and this is where we're gonna be sharing knowledge and information on how trading literally works. For now, it's a goodbye. See you in the next coming episode.